Ladies and gentlemen, good evening. Thank you for tuning in this series. We have myself, Dao Hong from the Fixed Income team. Together with me, I have my partner in crime, Randy.
Hello, everyone.
He's one of our market makers. What basically a market maker does is he takes care of the trading book. So basically, he's a trader. So today, we will be having a casual chat, right? For those of you who is joining us from home, the only house rule for us tonight is just to sit back, relax. In the case you have any questions at all during the course of the webinar, feel free to drop it inside the Q&A section, and hopefully at the end of the session, we will be talking about them with you guys. So just to get the ball rolling a little bit, today, and just to help orientate the floor, we have a couple of key themes that we will be discussing, and these are the themes that is happening actually in the market, and we are hearing all of these words being thrown around, especially with things like yield curve inversion, right? And you're constantly hearing, inflation that is creeping up. You have 8.5% inflation hitting the US CPI, and it is the highest in 40 years that they've seen. So all this inflation, stagflation, and the possibility of even recession that we might be seeing down the road, this will be some of the things that we'll be talking and sharing. And of course, towards the end, we will be sharing a little bit some of the actionable things that you might be looking if you are investing in fixed income, right? So this session, three things possibly: yield curve inversion, inflation, maybe even we talk a little bit about interest rate risks, duration risks, and what you can do towards the end. Of course, without further ado, let me just bring on board Randy. Right, Randy, when there's a lot of talk in town about yield curve inversion, right?
Yes, indeed.
Right. And what do you think? People say that yield curve inversion always predicts a recession happening, probably in the next 6 to 24 months, maybe up to 2 years. Can you share a little bit to our audience what is actually a yield curve, and what does a yield curve inversion actually mean?
Yeah, I find it is a very good timing to have this discussion and to specifically talk about inversion, recession, and also inflation or even stagflation. Because as we all know, right, we have started to enter into this endemic phase. So every country has loosened their border, their restriction, and everything seems goes smoothly and it goes very well. But can I proudly say that we have conquered, or we have gone through the coronavirus recession. And if you guys can recall, right, back in 2019, right, we actually witnessed one time of the inversion yield curve. And not long before, right, coronavirus happens and everything is in chaos, right? But can we really make a pinpoint that the inversion yield curve accurately predicted there will be a deadly virus coming into town that causes a recession hit? I mean, it's quite magical, but it's some sort of unrelated, right? But throughout the history, right, the inversion of yield curve actually predicted the US recession over the 50 years. And just last month, right, we have seen an inversion again, actually twice in March. So it's quite interesting, and people, started harping about this topic over and over again. So, but before we can make any judgment, whether this is it just a coincidence or this is a reliable indicator to predict the recession, right? But we first have to understand the fundamental of it. I feel like we have to understand the what construct this yield curve. Okay, so actually, right, in the world of bond market, right, when a government they want to raise funds, right, they will have to issue a new bond. to fund their spending and also to stimulate, to spur the economy. So when they do that, right, they will have to issue not just one bond, but they would issue different kind of bonds with different interest rate and also different maturity periods. It can be less than 1 year, 2 years, 3 years, or up to 30 years. Okay, so when we use all these government bonds and plot into a graph, right, it will be a little bit more mathematical way. So if we use all these interest rate and the years of maturity periods into a graph, right, they will sort of plot into a line which is called the yield curve. So essentially, right, if we sum it out, right, yield curve is actually just a line chart that shows the current interest rate with different maturity periods. Okay, so now we know the yield curve, right? So the horizontal axis will be the number of years, and then the vertical axis will be the interest rate. Okay, so when we see what we so called the healthy yield curve, right? Because yield curve can be any shape. It can be a straight line or it can be a curve. But what construct a healthy yield curve is actually a upward sloping kind of curve. Okay, so it will start low from the lower end, which is the shortest tenor of the curve, and then it will slope upwards towards the upper right, which is the longest tenor of the bond. Okay, so the healthy yield curve will be a upward sloping because in some way, right, yield is actually a return. So return supposed to reflect risk, and risk actually grows with time. As the time goes by, right, you will be enduring more risk. Okay, so just imagine when the chances of something bad will happen in 10 years, right, is actually bigger or larger than something bad that will equally happen in 2 years. That's why for long-term investor, right, they will actually, when they buy a long-term bond, right, they will ask for a higher yield or a better yield to compensate for the risk premium they will be enduring. Be it a maturity premium or liquidity premium, all these kind of things. Okay, so this is how the yield curve constructs. Okay.
So Randy, yes. So what Randy just shared was the idea that if you invest in the short tenor, you are expecting a shorter return because the possibility of something happening bad in the short run is definitely lower than the possibility of something bad happening if you have a longer term horizon. So what Randy just said just means that if you want to invest long, you will definitely want to demand a higher kind of return to compensate that holding kind of or anything that can happen, right? So Randy, right, you said that there's a lot of shapes in yield curve, right? When central banks around the world, come up with monetary policy, what part of the curve that it affects the most?
Yeah, that's a good question. I think instead of just talking blank, right, maybe we can show you some slides to visualize what we just talked about. Okay, so let me just share the slide. Okay, so this is just the headlines that we have been seeing throughout the month. This is the yield curve inversion, like I mentioned, and that it could actually signal a recession. Okay, so you can see these are the US Treasury yield curve comparing with the current curve and also the curve 1 year ago. So let us focus on the blue curve, which is the curve 1 year ago. Okay, so as you can see, the highlighted box one, right, is actually comprises of the shorter tenor from 1 month to 3 year bond. So this is considered the short-term tenor. So for this short-term tenor bond, right, the yield curve movement is actually driven by, like Tao Hong say, the monetary policy movement. Okay, so like what we are experiencing now. So the whole world is experiencing a inflationary pressure. So what the government can do is that they will need to increase the interest rate to make the borrowing costs more expensive. And then in the end, right, people they will spend the money wisely. They won't just simply spend or borrow money from the bank and then just do whatever business they want to do, because the cost to them is becoming higher. Okay, so eventually, at the rule of thumb, right, it will curb the economy from overheating, and hopefully it can stop the inflation or alleviate the inflation into a reasonable level. Okay, so when we talk about the curve beyond 3 years, right, is considered medium to a long-term tenor. Okay, so for this kind, right, actually the Fed can't do much for the longer tenor of the curve. So it's actually driven by market expectation. So if let's say a simple example would be maybe if let's say market is expecting a steady and moderate inflation, right? So they will have to ask for a higher yield for investing more than a longer period, let's say 10 years or 30 years. So in the case, right, the yield curve is in a healthy way, it will construct in an upward sloping, like I mentioned. So it's a very, I would say it's a very reasonable way to say so. So in the end, right, if I were to sum up, right, yield curve is actually a measure of market expectation. So if the future looks bright, right, then everything is normal. We will ask for a better yield, better return when we invest in the longer term. But if let's say the future looks a bit sketchy, right, then market is clueless actually. Then market has nothing, they have no clue what to do. So the yield curve might be a bit bumpy here, and it might flatten or even come into a inversion.
So currently we are experiencing a little bit of inversion. In fact, it's not a very large magnitude of inversion, right? And people talk about the yield curve inverting as a sign of recession, right? So let me just they call it the harbinger of recession. And why? Because it predicted the last 7 to 8. It is one of the most reliable, proven to be one of the most reliable indicators, and it has predicted the last 7 to 8 recessions. Right. So from the top, this seems like a very very strong indicator. But let's go back a little bit to the origin. Where all this yield curve inversion was first quantified. I just share a little bit of history here. The study was done by a PhD guy named Campbell Harvey, right? And this was exactly the first time the yield curves are compared, meaning the short-term and the long-term yields are being deducted, right? Minus out from each other, and there will be either a positive or negative number, right? The inversion happens when the negative number comes into the picture, right? Meaning your short-term, let's say 3-month rate is higher than the 10-year rate, and when you deduct the higher rate with the lower rate, then you will get a negative number. So this negative number is from the study that has been done by Campbell Harvey, right? Let's look at the chart here. It simply means that the more you go into the inversion, the more negative it is, the higher the possibility and the probability of a recession happening in the next 4 quarters or 1 year, pardon me. So this is taken from the Federal Reserve of New York, and basically they look at all these studies to support their policy actions. And right now we are looking around, at the current situation in the US Treasury, the inversion is not exactly parallel across the curve. It's just partially inverted. We are talking about 30% kind of possibility of a recession happening in the next year. So 30%, how do you even visualize the difference between 30% and 40%? It's very hard because the numbers are abstract, but certainly if you have a 30% of a possibility of a recession happening, it is indicating a possibility there. So this is the origin of the yield curve inversion acting as an indicator indicating a recession happening, right? We always, in 2005, before the subprime crisis, right, yield curve inverted around the year 2005, early 2005. It wasn't until 2007, in the month of December, almost 2+ years later, that the recession actually happened, right? So if people tell you, hey, yield curve inversion, yield curve already inverted, right? Tomorrow there will be a recession, then it might not be true. But whether or not the possibility of a recession happening, yes, there is a possibility of it happening. So we always like to use this analogy, and this is a very good analogy, I think, to share to the floor. A yield curve inversion is just like having a fever, right? And the higher the fever, it doesn't tell you what your sickness is, right? But it's a sign, it's a symptom, right, that something is wrong with your body, right? So this yield curve inversion, you can think like it like a fever. The higher your temperature, the higher the fever that you have, the probably the bigger of a sickness that you might have. So what sickness are we observing around the economy today, right? We are looking at, like Randy said, we have a lot of inflationary pressures, right? We have uh, inflation numbers that are skyrocketing, right? And you have China, right? Not only Shanghai in a chaotic situation, but maybe potentially if Beijing goes down the same way as Shanghai, would there be another blow to the economic activity there? And you also have war between Russia and Ukraine that has fed into the oil prices, or what we call the energy prices, and these energy prices are seeping into the inflation numbers very, very much. So, Randy, right, with all these things happening around us, all this inflationary pressure around us, there is talks that Jerome Powell, the U.S. Federal Treasury chairman, he is behind the curve, right? When people say Jerome Powell is behind the curve, they are saying that Jerome Powell is late to react, late to respond, and he has been keeping the interest rate for too low and too long. Right? This is what they meant by behind the curve. You should have acted faster, right, to control the inflation, right? Randy, can you share with us what are the potential ramifications if today Jerome Powell, even with 5 months ago saying that he is in the transitory camp of inflationary, all this inflation that they are seeing, he's in the transitory camp. After a while, he says that inflation is there to stay, and today he is asking for more rate hikes. Right, 50 basis point is not enough. Maybe perhaps another 75 basis point possible that is happening in May or in June. So, Randy, all this possible inflation, what can it lead to? If Jerome Powell's rally his counterparts to hike the rates aggressively, what can happen? What are the scenarios that can happen?
Jerome Powell definitely has the toughest job to do, right? Because the like what you said just now, they initially say that it's just a blame. Inflation is just a blame. Then it will just transitory, and not long before, right? Then they literally retire the word transitory, which is quite interesting. And I think coming the FOMC meeting in May, right? The 50 basis point is in rate hike is actually on the table, right? So it's quite interesting. So in the case of the possible scenario, right? Let me also share you a simple slide to visualize a bit. Okay. Let me share the slide to you. Just a minute, I think. Okay. So this is actually like Tao Hong mentioned, they will be the gray highlighted boxes is actually the time where recession happens. So it isn't a actually the yield curve isn't magically predicted the recession on the horizon. Okay. Okay. So this is what Jerome Powell said. Okay, so as we all know, right, market has actually started pricing in the 4 consecutive 50 basis point of rate hike in this year, and then another 3 to 4, maybe a quarter basis point hike by 2023. So they are targeting to increase the rate to interest rate to 3% in order to control the inflation rate within their target rate of 2%. So this is what market is pricing in, not just bond market, but same goes to stock market as well. But what if the things don't turn out very well? Let's say the inflation situation is larger than what the Federal Reserve could expect. So in this case, right, we have listed out 2 different scenarios that will shift the market pricing out of what is currently doing now. So let us look at the green box. So the green box is what we so-called the soft landing scenario. So soft landing, literally, it means that central bank, they has done a really good job to control the inflation without hurting the real economy. Okay, so in that case happens, right? I mean, in that case happen is really a ideal situation. So in this kind of ideal situation, right, the yield curve hopefully will slowly go back to the healthy shape, which is the upward sloping, and then people will just have a happy ever after life. Then they will just enjoy everything they could back to normal life. Okay, so and also in future, if let's say, because economy is sort of these cyclical things, right? So if let's say they have hiked the interest rate to 3%, right? Then in future they might have more room to cut interest rate if needed, lah. Okay, but if let's say if we look at into a more pessimistic scenario, right? Looking into the rate boxes, then if let's say Fed they had hiked the interest rate into a reasonable level. Maybe I'll need to share the slide again to let them have the better picture. Okay, so if let's say they have hiked the interest rate to their target rate 3%, but the inflation is still out there, it's still out of control. So in that case, right, they will be facing 2 scenarios here actually, because imagine when the interest rate high, right, it means that the borrowing cost is also higher. So for all those corporations, right, it's actually a cost to them. So their income will be lesser, and then they will have to sort of cut their operating costs outward. So it will indirectly lead to a high unemployment rate, and also their income goes lesser, right? Then it will sort of alleviate the economic growth. So does it ring a bell? It will actually link to stagflation, which is a very scary thing. So if stagflation really happens, right, then they will be, I mean, Fed, they will definitely in a dilemma, right? Because they will need to choose whether they want to stimulate the economy or they want to continue control the inflation, because they can't achieve both goals at one approach, right? So this will be the dilemma that they have to face. Then if let's say they choose to continue increase the interest rate to further control the inflation, right, then I mean in worst case scenario it might lead to a recession. So it's a very, I mean, this kind of macroeconomy event is actually beyond our control. So I mean, what as an individual investor, right, what can we do to actually reposition ourselves to make sure that we prepare the unexpected?
Okay, before we go into that, let me just also add a little bit to what Randy has just said, right? Stagflation, right? This word it is also coming out from our webinar topic, right? What is stagflation? Stagflation is a situation where you have a flat, very flat growth, but you are also experiencing a very high inflation. Right, and the challenge with the Federal Reserve or any central banks in the world is that they have 2 objectives that they are, they have 2 jobs basically. Well, the first job is to maintain price stability, right? What we call control the inflation, right? They have to make sure prices are not too hot, economy is not too hot. And when the economy is too hot, they have to control it with their monetary tools. And the second job they have is, which is also very important, is to promote employment or reduce unemployment. So these two objectives doesn't go hand in hand, right? You can have either or. You want the economy to grow, you want a low unemployment. Sometimes you gotta let go, or you gotta you sometimes you gotta get let prices go a little bit, run a little bit hot. So these are competing, what we call competing objectives that the central bankers around the world, like Randy said, have the toughest job in the world. So we salute to them, but everybody is pointing fingers to them because they are basically, if you look at US, they are basically fixing something that they have caused themselves earlier in the pandemic, when they flushed the market with so much liquidity, propping up the stock market. Whatever they are doing now is reversing that effect, right? And you can see it in markets already happening. Yesterday, the Dow, one day you have around 3.8 to 4% of correction, which is one of the worst days since the start of the year. So by doing all this, by reversing, by increasing interest rates, they are effectively undoing whatever they have brought to the stock market. But of course, today we are talking about bonds. Like Randy said, as a bond investor, what can we do? What are the avenues we have, or what are the strategies that we can apply to our picking our bonds, especially when you are investing in bonds? What should the criteria be? So let's look at the next slide. Maybe I'll just jump into the first one, Randy. The first one is short duration play. When we say short duration, it means that you are buying a shorter tenured bond, right? Compared to a longer tenured bond, you're gonna choose the one that has a shorter maturity, maturing nearer in the future. The reason why is because a shorter bond has a lower sensitivity, right? The word is sensitivity. That has a lower sensitivity compared to a longer term bond, longer dated bond when it comes to interest rate changes. So to give you an example, right? If the bond is 10 years duration, right? Or we can just understand it simply 10 years long. If the bond is 10 years long, every single percentage of interest rate hike, 1% of interest rate hike will reduce technically, right? In a perfect world, will reduce the bond price by 10%. This is what we call duration, right? So in an inflationary interest hike prone environment, we will choose something that is shorter. The reason, once the shorter bond matures, you can actually reinvest the money into a higher yielding or higher returning kind of bond. So if you lock yourself in too long, you will be missing out the higher interest rate. That is the idea. So second one, maybe Randy, you can jump in for the second one.
I guess in this kind of volatile market, right, for bond investment, right, because bond is always act as a defensive asset to successfully achieve the diversification purpose. So I think in selecting bonds, right, I think we'll need to look at those investment graded bonds with definitely good credit quality here, because bonds, its ultimate objective is actually to give you a steady and also the regular cash flow. This is the most important thing. And you might be thinking that, what if the return that I'm getting from this kind of investment graded bond doesn't really beat the inflation rate? But I think at this moment, right, we will need to, the best case scenario is definitely to beat the inflation rate, but in some way we have to find a balance to sort of give you a regular cash flow while partially, I mean, it might not be a good word, but it somehow partially beat or conquer the inflation rate that we are experiencing. So I can see the third option is actually encourage us to choose a higher coupon rate bond. I mean, how does that work?
Yeah, but just before I go to the higher coupon rate bond, what essentially Randy is trying to say is that in a situation or in an environment where recession and the economy is not doing too well, you might want to focus your selection on higher quality bonds.
Yeah, that's the
That's
most
that,
important
that's
point.
the most simplest idea, and you want to avoid those probably that are what we call high yield bonds or maybe speculative bonds, because those would probably perform not so well in this kind of recessionary situations. And for higher coupon bond, let's take a look at the slides again. For higher coupon bonds, why do we choose that? Is because higher coupon bonds act as a cushion, right? You can imagine it like a cushion. With a higher coupon, the sensitivity to an interest rate hike is lower, meaning, right, in the case comparing, just imagine if you have a bond that is giving you a 3% coupon and another bond that is giving you a 5% coupon, right? When the interest rate hikes, right, the 3% coupon bond that is paying you 3% will be worth lesser because 3% is easily beaten, right? While the 5% one, you still have a little bit more buffer. So in the case during an interest rate hiking environment, go for the one that offers you a higher coupon bond because it is more defensive and the bond prices will be less sensitive to a hike in interest rate. So this is the idea: higher coupon bond, less sensitive to interest rate hike. The impact on the bond price, if really a hike happens, is lower, and it is a cushion towards your portfolio cash flow, right? So the cash flow, this is the cash flow component. And the next point about floating rate bonds and inflation linked bonds, Randy?
I think throughout the years, right, what we have been investing is sort of investing in sort of the fixed rate bonds, right? Because that time it was actually in a very low interest rate environment. That's why people will tend to lock the rate, because the rate is actually your cash flow here. So, but in this case, right, this is completely opposite way because we are experiencing interest rate hiking environment, right? So when we invest into a floating rate bond, right? So floating rate bond, they will take a benchmark, which is the government bonds as the benchmark. Then they will follow what the interest rate movement. So if let's say currently this month the interest rate for 3-month bond is giving you let's say 1%, then the next 3 months, right, it hikes into let's say 2%, and so that your bonds, right, it will follow the what we so call the current interest rate in order to enjoy a higher interest. So your interest rate risk is actually the lowest, right, in that case. Okay, and also for the inflation linked bond, right, actually there are some bonds who is tied or linked to the inflation data like CPI. So if let's say the CPI data goes higher, right, your coupon rate will actually go higher as well. So for these two bonds, right, I would say is a good hedging tool to hedge interest rate and also inflation pressure here. But I look at the final point, right? You encourage us to invest in bank bonds.
Yeah. So for bank bonds, especially capital instruments like Tier 2 or AT1 bonds, basically they are just suggesting that these instruments that are bonds lah. Basically, they are bonds, but they are hybrid instruments that represents the capital of a bank. And usually in a interest rate hike environment, banks expands their net interest margin, right, which is basically how they earn money, right? They can borrow or lend out money at a higher whatever, your mortgage or even your hire purchase, your personal loans, all these are pricing in a higher rate in a higher interest rate environment. So banks generally enjoy that expanding margin or better business, like in better bottom line in this kind of scenarios. But of course, banks are also gonna be worried about during a recessionary like or maybe a weaker economy, borrowers' quality gonna be lower, right? People might be defaulting on their loans more. But generally, if you go for bank bonds today, banks are well capitalized, maybe in the mid-teens, 15 to 20%. They have a very strong capital base, and they will be giving much higher kind of return. Let me just share a little bit. If you invest in a bond today that bears the name maybe MBSB Bank, right? The bond may be callable in 5 years, maybe close to 5 years. The bond can actually give you close to 5% kind of return, or maybe around 4.8 to 4.9%. So that is considerably a good return. And for financial institutions, you sort of know they are well regulated. Some are systemically important. If you go for global banks like HSBC, they are systemically important. So these are some of the choices that you can look at. Bank bonds, right? So let's wrap up a little bit, Randy. We started the whole conversation sharing about what we will go through today, especially yield curve inversion, right? We talk about yield curve inversion. We talk about stagflation, the idea of stagflation. We also talked about the possibility of a recession due to the actions of central banks around the world. Will they push the economy and buckle the economy under the weight of too high of an interest rate? So let's maybe move on to the Q&A session. We have probably quite some time to answer some questions. If you guys joining us from Facebook and YouTube have any questions, or even want to follow up with any questions later on, you can write in to us always. But those who are with us in Zoom right now, you can drop your questions in the Q&A. We are seeing some questions coming in. We will slowly address them one by one. But maybe let me just ask you one question, Randy. I'm seeing this. What leading events? This is the part that you covered. What leading events and indicator from an anonymous should we look out to know if it's a soft landing or hard landing? Maybe we can have a discussion here. Maybe I'll just open with my 2 cents. My 2 cents is right. The probability of central banks hiking aggressively and not impacting the economy is very low, meaning they would first of all, they have to raise the rates aggressively. They are forced to do so. They are pushed to a corner. They have no choice but to raise it hard and raise it fast, right? And when they do so, at this current situation, there is a very high chance of pushing the economy into a recession. Right, the soft landing scenario, I think
that is the ideal situation. We
are both assigning a very low probability of that happening.
But it could happen.
Yes,
it could happen.
It could always happen. So what do you need to look at, right? Of course, we talked about yield curve inversion, right? Today, the inversion is a little bit only. What if it goes to, it stays inverted for a long time, and it stays inverted for a bigger magnitude? It's no longer 0.17. It could be 1 or 2% inverted, this kind of situation. So to me, if you look at the yield curve inversion, yes, it is a very strong indicator, but it doesn't mean that it will be a recession. But soft landing, not a very likely scenario to us.
Yeah, I mean, yield curve in some way, they are saying that yield curve is actually a leading indicator because most of the transaction actually happen in the bond market, also called the money market, right? Money market means all those bonds within 1 year maturity. And then some people, they might look at stock market as the leading indicator to reflect the market situation. But I mean, one thing you need to take note is that stock market performance isn't really equivalent to our real economy, right? So when we need to, I mean, if you want to look at those statistic data, right, maybe yield curve can be a reliable indicator for you to refer. But if we are talking about the real economy, right, I think personally when what's surrounding us will definitely be a good one for us to really feel that whether we are in a good economic performance or is it we are having a recession. I mean, just look at the things around us that you will have the idea whether what kind of situation that we are facing.
Yeah, of course, there's a lot of indicators. At the back of my head, people look at consumer sentiment, right? People talk about, whether your sentiment, people are spending money happily. And you can also, look at manufacturing index, right? Those are surveys done that gives an idea whether or not people are producing or investing in capex, right? And you can also look at things like real income, right? Whether or not inflation is eating into our income, and if it is eating into our income in real manner, then our income is effectively shrinking, right? If your wage growth is 2%, but your inflation is 10%, effectively you're earning less 8% every year. So these are the things, real wages, right? You have even people looking at the housing activity. Housing is one of the biggest component is in most of the people's what we call asset, net asset, right? And if housing slows down, it actually pulls together a lot of other economic activities because of the wealth effect, right? And when people don't feel wealthy, they don't spend, right? Things don't move. If they don't spend, they say that one man's profit is one man's cost is another man's profit. So these things don't trickle down. So it is a lot of things for you to look at, basically. But yes, the yield curve inversion is the fever. Like we say, we like to look at it as a fever, and there's definitely something wrong. And if your fever doesn't go away, you know that definitely something's gonna happen down the road. So
Something is not normal here.
yeah, maybe let's move on to the another question.
Let me see.
See which one is.
Okay, I can see some people are talking about our Malaysia government yield. Because just now the yield curve that we are showing is actually from the United States. So some people were asking what is the outlook for our MGS 10 years. So MGS stands for for those who don't know, MGS is actually the Malaysia government securities. So if I could remember correctly, our current MGS 10-year bond is yielding around above 4%. So I think from what the latest announcement made by Bank Negara Malaysia, right? Because some people might question Bank Negara why they don't follow the United States footstep, because the United States has been rising interest rate, but our government, our central bank, they still staying put. They didn't do anything. So they are claiming that this the inflation that we are experiencing is actually what we so called the cost push inflation, which is the supply driven kind of thing. So they think that by rising interest rate doesn't effectively resolve this cost push inflation, but based on the economist estimate, they are expecting maybe a rate hike in second half of the year?
Yeah, I mean, if you look at the markets, I have the latest numbers, actually the closing yields for today, right? We are very, very far off, different from where we are maybe even 6 months ago. Right? 6 months ago, imagine 10-year MGS, maybe you're talking about 3+%, 3.5%. Right? Today, 10-year, let me take a quick look at the numbers. 10-year, we are talking about 4.3, 4.4, 4.3, 4.4%. So that is close to 1%, 80 basis point difference. But again, for those of you who hasn't invested in MGS yet, today is a very interesting time to look at, right? Because if you are getting a risk-free asset, right? Technically, every government bond is risk-free. Is considered risk-free in their own country. But we have seen, of course, countries defaulted on their sovereign bonds before. But that aside, government securities, MGS, they are considered risk-free, and that's why they are most sensitive to interest rate changes. But they are credit risk, right? Whether or not they can pay their coupons or maturity, that one, the credit risk is very low. Okay. So MGS, yes, you can take a look at it. Very interesting levels, and they are also trading higher than pre-pandemic levels. So it's already higher than pre-pandemic levels.
So market has actually started pricing in the possibility of interest rate hike in the coming months, or maybe we will expect to see in the second half of the year.
Yeah, I mean, thank you, our audience, Stephen. 4.29 MGS. I think GII is higher slightly at 4.46. Yeah, so GII is definitely giving a slight better pickup here. But anyway, yes, MGS 10-year yield around 5.05. I don't think so. But anyhow, yes, there will be information available on this through Bank Negara's website. I think they also they also report all these daily movements.
Yeah, they will do the reporting.
Let's take another question. Maybe Jandy, do you have anything?
Let me see. Let me see. I see quite a lot of people making comment on MGS.
Okay, maybe we should address also what is the outlook of BNM rate hike quantum this year. Of course, the market has already said or priced in 2 rate hikes, and each rate hike is 25 basis point for the second half of this year. And it's already reflected in the market. You can see the 10-year has already moved more than 50 basis point, 80 basis point, of course. So the thing that would push Bank Negara to move more is the surprise factor, the X factor for inflation. Right now, our inflation, last year we averaged around 2.5%. This year, expectations are around 2 to 2.5%. That's why maybe Bank Negara is still being patient with their rate hike plans, because our economy is not on the headline. Let's put it this way: on the headline, they are not overheating too much. But of course, inflation means different thing to different people. Me and Randy may have a different meaning of inflation. What we spend, can differ from one another. And inflation, the CPI, is just a basket of goods, and it can affect one person more than the other person. So inflation is very subjective, and sometimes people say inflation is underrated. But anyhow, this X factor, this surprise in inflation, if there is a surprise in inflation, then Bank Negara have to act more aggressively. Same like the US Treasury, same like the Federal Reserve. Last time they say, nothing's not so much of a problem. Inflation is just transitory. But now look at where they are. They have to move faster, right? let's see if we can take another question.
I just saw one question. There's a participant asking, right? Because we have been witnessing a depreciation in ringgit, right? Is it advisable for them to look at foreign exposure, maybe? I mean, because it's always good to achieve what we so call the diversification, right? So by investing into foreign bonds, right? Let's say Sing dollar bond, US dollar bond, or even offshore renminbi bonds, right? You can get to enjoy not only the bond income but also the uh, FX movement that you will be expecting. So if let's say we are expecting more appreciation in US dollar to a ringgit, right? Then you can actually enjoy two sort of the income component. But definitely, you need to you are actually having another exposure, which is the FX risk as well. But definitely, it will be a good one to diversify your overall portfolio.
Yeah, diversification in terms of currency definitely is more very important. We can US dollar is at a new new high. If you stay in Malaysia, but if you're I don't know. People say if you stay in Malaysia, you don't feel the impact, but I don't think that is the case. You should consider purchasing power, right? Always looking at purchasing power. How much your $50 can buy today compared to where you are 10 years ago. So diversification, yes, US dollar, renminbi, Sing dollar, and you can achieve that through our Bond Express. Why I say Bond Express? Because that is 5,000 minimum nominal to start with. It's not asking you 200,000 nominal amount, right? It's just 5,000 nominal amount, which is equivalent to around 20,000 Malaysian ringgit. So it's much more accessible to our investors. Remember this, Bond Express, you start as low as 5,000 nominal in the bonds currency, right? So 5,000 Sing dollar, 5,000 US dollar, right? And ringgit as well, of course. Maybe I'll just pick another question from
Yeah,
the
I think we
floor.
can try to answer one or two questions. Let's see.
Views on China high yield property bond. Maybe we'll
That's the tricky question, but this will be the concerns that many investors have in mind, lah. I think China China government, they have been making a move aggressively to make sure that they are able to support not just property market but the overall financial market. So China government, they just instruct all the banks, right, to lower their reserve requirement ratio to make sure there is more money supply in the market. And also, I think last week, days ago, I just read the news that they are asking banks to loosen the restriction to lend more money to those property companies who are looking to restructure their overall credit position. So I think they have been doing a good job to make sure everything is stable.
So to add on what Randy has said, you can see the central government in China trying to provide the necessary support, right? Not letting the whole industry go down, right? They give loans for M&A purposes, right? Asking the larger property developers to take over or acquire those weaker developers, right? You see our reserve ratio cuts. You see even faster mortgage processing, right? All these things that the central government is trying to prop up the industry. But one thing that remains is, to me personally, that the buyers are not coming back. Right? If you look at the numbers, even month on month, year on year, sales of new homes are very, very weak and they are in a decline. So whatever the Chinese government do, whatever the regulators do, as long as the buyers do not have confidence to buy home, sign the SPA, right? If they are not coming back to the market, there is still challenges going ahead. And just to share a little bit we have investors going through bonds that have defaulted. Me and Randy, we personally sat through a lot of painful restructuring documents. Those documents are probably 300, 400 pages, and we have investors that are experiencing that. But yes, there will be challenges going forward. But again, it is looking more like a too big to fail scenario, right? Although Evergrande has gone down, they cannot let the entire thing become a domino. I would say that. So maybe one or two more questions. I think we still have time for one or two more questions.
I just
We'll
see.
try to answer if we can have more time. We will be glad to answer more questions because we like how the questions are coming in. How to identify investment grade bonds and high coupon bonds. Okay, let's go back to the basics. Maybe just talk a little bit about basics again. Maybe you can go up a little bit. Yeah. So investment grade bonds is basically ones that are triple B and above, right? You look at the rating. As long as triple B, all right, single A, double A, triple A and above, triple B and above, they are called investment grade. Those below are called non-investment grade, or people call it junk bonds or speculative bonds. Right? High coupon rate bonds is very straightforward. You look at the coupon rate that the bond pays. Right? The higher it is, the better in a rising interest rate environment because you're getting a higher cash flow. So that was what we covered in the session, right?
I just noticed a question that is very suitable for us to wrap up the session. There is a participant asking, right, due to this interest rate hiking environment, right, is it better to stay put or we should keep investing? I think, okay, let me just come up with my personal opinion. I think if you choose to stay put to wait for the interest rate hike, then you only invest into the new bond, right? I think you might be lose out a lot of opportunity out there. So that's why we are encouraging you to invest into a shorter tenor bond to get what you are supposed to get in this investment while wait for a better opportunity to come in. So if let's say you are investing into a 2-year bond, once the interest rate has has risen into a suitable level, then your bond has matured, then you can use the money to invest into something else. So I think we should keep investing and to at the same time to look out more opportunity. Do you have any things?
Okay, my 2 cents is yes, right. Fixed income can be not the best thing to invest in during a rising inflationary environment because you're getting a fixed rate of return, right? And let's say you fix your returns for the next 5 years. If the inflations are higher, the interest rates are higher, you're getting the same return. That's why fixed income or bonds generally can be devastated during this kind of environment. Right? But again, right, going forward, if you have let's say a 5-year horizon, right? You have a 5-year horizon, and you look at a bond that is giving you maybe 5% return, and you look at the company, the credit of the issuer, you have issuers, maybe even the most recent, let me just share a name back of my head, Johor Corporation. Johor Corporation is coming to the market to raise a new bond, maybe 5, 7, 10 years, and they are indicating maybe high 4.7% to 5%, 5+% kind of return, and they are rated triple A. Of course, ratings, triple A is the strongest rating we have for a corporate. They are state-backed, Johor-backed. And if you look at their returns and you say, okay, 5 years, 4.7%, I'm happy with it. I can sleep well. I'm maybe the most I will be beating inflation a little bit. I'm happy preserving my capital, getting the cash flow in time. I can plan my retirement. This is something to consider as well. It's not that you always have to maximize your return, right? Some people, they invest in bonds for the purpose of planning their cash flow, right? Planning their cash flow and preserving their capital. And if you are comfortable with the credit like I mentioned, Johor Corp or even bank bonds, giving you a 4.5% kind of return, you should allocate a little bit in those bonds. And of course, I saw someone saying that bond funds are giving you a negative return. Of course, bond funds, under the bond funds, they are holding a basket of bonds, right? They could be holding longer tenured bonds that is being hammered by the rising interest rate and the rising benchmarks. So if you are in bond funds, keep investing, right? Bonds are usually in Malaysia, except if you heard about it, some highways that defaulted, or even server dynamics situation, they have defaulted on their offshore bonds. Seldom we hear bonds that go into trouble, but of course, credit selection is very important. Credit selection is always very important. Take the risk that you can stomach. Pick up the risk that you can stomach. So maybe
Yeah, I always love the quote that time in the market is always better than timing the market. So keep looking for the one that is most suitable to you.
right.
Okay.
Maybe can we have one last question? We're enjoying ourselves here. Okay, that's one last question to wrap up the session. But in case you have any follow-up question, feel free to reach out to us. We have our dedicated dealers, our research analysts to help you answer your questions. Even if you're new to bonds, don't be shy. Come, we want to make bonds more transparent, information more accessible to everybody. Learn about bonds. Even if it's the worst time to learn about them, just learn about them. See if there's a place for them in your portfolio. So this is maybe the last question, Randy.
Please.
Let you do the honor.
Okay, there's a participant saying that the Asian high yield has already gone down to 30%. So should they average down or just exit? I think this will be more related to unit trust. But what's your view on Asian high yield?
Okay, there's a very simple theory called the mean reversion. Right? This theory means that whatever goes down comes back up, right? Whatever goes up comes back down. At this current situation, Asian high yield, the biggest component is of course China property market. I think it is the most biggest chunk of the Asian high yield market, and it is down 30%. I think at some point it's down even more. If looking at the historical spreads right? Of course, now the spreads are crazily high. You can maybe the spreads are 700 basis point or more, right? Because the yields are off the roof. Issuers cannot borrow from the offshore market. And if you ask me whether or not to top up, there is, people say, a little bit of value if you believe in this mean reversion. But again, the situation with the Asian high yield, especially the China high yield property market, is very, very precarious. There is a lot of uncertainty given now that the lockdown situation in China is just exploding. I have friends in China that shared with me the whole system just collapsed in Shanghai. So if that happens in Beijing, it will be another blow to the central government, and they are having their Congress later part of this year, where Xi Jinping will be probably facing another re-election. So all these things are still there. Of course, the Chinese government has also showed their support by coming up with more than 24 measures, the latest, to support the economy. By all means, even cutting the reserve ratio for banks, even the FX reserve being released to the market. All these things, what they are trying to do, they want to support the market. And if there's a 30% discount in the market, I think you can actually average it down. If not, it's very hard to imagine you breaking even, right? If you don't average it down, right? So continue to be disciplined, continue to diversify, continue to dollar cost average, right? Take maybe sectors or even regions that are having a long-term potential, right? China or even Japan, right? Take a look at those markets, and if you have any questions at all, we are not the UT experts, of course. Sorry again, we are not UT experts, but we have a team of client investment specialists that you can call in to ask for more advice, and we are
Always
more than
support.
happy. We are more than happy to link you up with them. So continue to support us in our future webinars. Maybe Randy, any last comments?
I think for those who are looking for bond recommendation, or you are looking for advice for the repositioning of your portfolio, right? Just feel free to drop an email to us. Then our client specialist team, or even us, Dao Hong, either you want to pick Dao Hong or me to give some advice, right? We are happy to do so. So again, although we are losing the restriction, but just stay safe. And also for those who haven't had your dinner, enjoy your dinner.
Okay, that's it from FSMOne for tonight. We wish everybody a pleasant evening and see you next time.